In this video, we are going to take a deep dive into the most important candlestick patterns, but I'm not just going to show you the candlestick patterns that you already probably know. We are going to look behind the scenes in this video. And the goal with this video is to understand price structure, candle microstructure, and how to find the best trades using independent candlestick information that will allow you to find the best trades every single day. Let's start by looking at the engulfing candlestick, and I'm sure most of you will probably have an idea of what the engulfing candlestick is, what it tells you. But still, a lot of traders fail and struggle using price action. And in this video, my goal is to help you get over those hurdles and help you look at candlesticks in a different way. So when we look at the chart, the most far right candlestick is an engulfing candlestick. Why is it an engulfing candlestick? Because the high and the low of this green candle is completely engulfing the previous one. So this is a high momentum candlestick, which shows us a very important and very strong turnaround in the market. So it is a bullish candlestick, and we have to analyze and ask ourselves, does this candlestick at this point in time make sense? So let's zoom out and let's look at the whole picture. What can we see is that the market is in an uptrend. We have up waves, down wave, up wave, down wave, up wave, and another down wave. And at the bottom of this down wave, there the engulfing candlestick is occurring. So it does make sense that engulfing candlesticks could mark the end of this correction phase, and it could be the transition into the new impulsive phase. So that is a great candlestick location where it makes sense in the overall context. It's into the trend direction, and if we can time the low of this correction phase, we are probably going to be very early on in the next impulsive leg. Another thing that you could do is look at previous support and resistance. In this case, here we have a previous high point of an impulsive wave. So when we just extend this to the left, we can see that it doesn't fully line up. So the high of this candle doesn't fully line up, but it's very close that we can assume that previous resistance is turning into support. It's actually a great sign that the market is turning a little bit ahead of this previous resistance, because it shows that the buyers are rushing into the market sooner than expected. You would expect the market to bounce here off the previous resistance as support, but as the market is coming lower, the buyers are buying the price up sooner. So that's a good sign actually for us. If you are using moving averages, you could also add the 21 SMA or EMA. And what we can see is that in this uptrend, the market repeatedly bounced off the moving average before moving higher. And here we're seeing it again. The market is trading at and around the moving average, and it's looked like it's bouncing again now. So another great confluence factor. So how do we trade this? For that, we go to a lower time frame. When we're now on a 30-minute, you could also go to the 1 hour or to the 15. That's really up to you. We look at this trend structure here, and what can we see is that on the micro level here on the intraday chart, the market has broken out of this bottom structure, right? We have a triple bottom at the 30-minute. The fake out is here. And even more interestingly, the price is now breaking into higher highs here on the lower time frame. We also have a break and retest structure on the lower time frame where we have the breakout above the previous highs. The retest is challenging here the stops. What do I mean by that? Just put yourself in the shoes of a breakout trader, and let's assume you get in here on your bullish breakout. Where is your stop going to be? It's definitely going to be underneath the resistance. Most of the stops are going to be in this area, and this is why we call this a stop zone. And when the market moves into the stop zone and then finds immediate support and bounces back higher very quickly, that's what we call a stop run. The stop run is only completed when you see strong acceleration away from the stop zone. At that point, we could just initiate a long position right away. In this case, you don't have to even wait for another signal because everything is already here. Our stop loss could go below the last swing low, and we zoom out, we can see that we have a few resistance areas that we can work with. So here's probably a first very important resistance because it has been resistance here and here. And then we have the highest point of the previous trend leg. But keep in mind, when we are on the higher time frame, we are trading with the long-term bullish trend. So in theory, we could also try to capitalize on much larger trending moves when the price keeps going and pushing into new highs. So those levels that we marked on the lower time frame could be your first or second target. And then you can also implement a trailing stop loss approach where you try to ride the trend for much longer. So our first target could be here, And what we see is that we already have a 2.5 reward to risk ratio trade. That's not too bad. In this case, when we target here the higher of the trend wave, we have a reward to risk ratio of 3.6. This is really exceptional for a good trend. But we could also decide to trail our stop loss much further when we are trading with the trend. So let's see what happens. The market is pushing higher. It's facing a little bit of resistance. It's advancing higher. Let's zoom out and see what the market is doing. We're running into opposition. The market almost hit the first target, but is bouncing. We see a lot more opposition now, but as we trade into this noise zone, that is kind of what we expect. When the market is breaking into those areas, you will often see quite erratic movements. So as you can see here, we had a lot of sideways, and that corresponds to the sideways here. So this is an area that the market already battled over in the past. We saw it here, but there were no real signs that the trend is changing. And because we are trading with the higher time frame, as we have seen, this can give us confidence in the trade. And we don't need to bail on the first sign of weakness. And what we can see now is that the market hit our higher target as well. Just out of interest, let's see what happens afterwards. The market is even advancing further. And now it's really showing a lot of strength. When we look at it now, we see higher low, higher low, higher low, and the market is just keep going here on the way up. So at that point, because we are trading with the higher time frame as we anticipated, this could have given us a lot of confidence in our strong entry signal. There would have been other entry signals here along the way if you've missed the first entry. For example, here you could have had a cup and handle pattern that I can point out for you here. This is the cup part, the handle part. You have the breakout, the retest of the cup and handle, and that could have been your next entry. Or even a little bit later afterwards. Here we have another break and retest, just like on our first entry point. We have here a cup part, handle, second handle, breakout, dirty retest, continuation, and the market keeps going higher. And all of this started from our engulfing candlestick pattern on the daily time frame, which formed at the perfect price level and helped us anticipate this move. If you like this way of trading, make sure to check out my ultimate trading program. It's a trading course where I summarized my 16 years of trading experience into a few hours worth of video content. But there's so much more than just videos. You receive support from me 7 days a week. Every day, when you have a question, you can reach out, ask me questions, and I will respond to you 7 days a week. The trading program here consists of a trading course. There are over 80 new videos that I've never shared anywhere else before. The mentoring part is included. We have regular live webinars, and you will also be part of a lively community of traders from all around the world. I'm not using other teachers, I'm not using other mentors. You will be able to interact with me always directly. You learn my day trading strategies, my swing trading strategies, and you can apply to all the different time frames. Whether you are a completely new trader or you already have some experience, the course will help you make the step to the next level. The course in this program helps to build up your trading knowledge step by step. Here's a rough outline of the course, and as I said, there are over 80 brand new videos, so there's a lot for you to learn, and you will learn my actual trading strategies. I have dozens and dozens of trade examples for you. I show you how to backtest it. I give you my exact price action entry rules, and I'll show you exactly how to trade and how to prepare your charts. We also currently have a discount running, so make sure to check the link in the video description. And now let's get back to the video. The exact opposite of the engulfing candlestick is the inside candlestick. And this green candle is an inside candlestick. Why is that so? Because the green candle is completely inside of the red candle. So you could also say it's a reverse engulfing candlestick because the previous one is completely engulfing the small one. And I'm always so excited when I find good inside candles on a daily time frame. But the most important part is that they need to form at the right area and in the right context. What's the context here? The context is a downtrend. So the market has been selling off here quite strongly. Then we also form here a small consolidation area, and the engulfing candle has broken out of this consolidation here. The inside candle, if we look just at pure support and resistance, is retesting the previous lows of the consolidation. So the candlestick here, the large one, is breaking out, the green one is retesting it. And what a small insight day tells us is that after a strong breakout day, the market is not immediately continuing on the way down. However, the market is digesting what has happened here, and there's no strong opposition to the breakout. The smaller the inside candle, and especially the closer the close to the low here of the candlestick, the better it is. If the inside candle would have had a close very high, that's not a good sign because it shows that the price was able to push much higher against the breakout candle and the buyers were able to hold the price higher here at the end of the day. But in this case, the market pushed higher, was rejected, and is now almost at the previous low point, or at the previous close at least. So now we know we're in a bearish trend. We had the breakout. After the breakout, the market didn't push back and didn't immediately fall back inside of the range, and the candle retested here the previous lows. So what we now do is we want to look for continuations to the downside. For that, we draw here the low on the inside day and we go to a lower time frame. On the lower time frame, we get this. What does this tell us? So this is here the low of the previous consolidation, right? Then we have the breakout, the retest, and this little area is then here our inside day that we saw on the higher time frame. That's the candlestick microstructure when we zoom in and look inside of the inside candle. So a very simple trading plan could involve waiting for the breakout here into a new low, a break and a retest as well, and then we want to trade into the direction of the higher time frame. And this approach allows us to start our analysis on the higher time frame where we identify the trend, and then on the lower time frame we really sniper our entry point. This way of looking at lower time frame entries gives us the opportunity to get in very close to the perfect price where the market is on an intraday basis tipping from a long or from a neutral perspective to a bearish mode, and this allows us then even further to have a very small stop loss and a huge reward to risk ratio because we're trading with the trend. We have here a breakout candle just a little bit after, but that's not ideal. And what I teach in my program is a so-called hook or just a retest. So what we have is a break and a retest. We want to see that the market is falling back inside of the pattern. And then the most important point, after the market is falling back, we want to see a very, very strong bearish push here into the direction. The strong bearish push is important because it shows us that the bears are taking over into the long-term trend direction. So now we have the perfect setup. You can see the market pushed higher, and then we have 1, 2, 3 extremely large bearish candles. And this candle here, even though it has a wick, that's not a problem. The candle here takes us below the close of this candle. So at that point, we have a high probability short scenario. Of course, if you find this in another context, you can also trade this as a long. But in this case, we're trading this with a higher time frame downtrend. We can extend our target here significantly because we are trading with the higher time frame trend. So let's see if we go for a 3-to-1 reward to risk ratio, what happens. And you can see the market is moving lower. We have a little bit of a back and forth, nothing too major at this point. The market is struggling here a little bit, but it's never challenging the downtrend that we're anticipating. The 3-to-1 reward to risk ratio would have been hit now. The market keeps going a little bit further, but at that point we probably would be out. But if you're trading with the higher time frame trend, you could also implement a trailing stop loss approach and try to ride this trend even further. And again, remember, this all started with the higher time frame inside day after the breakout. And the inside candle is not just an inside candle. It tells us quite a lot about the market structure and the buyers and the sellers that are interacting in the markets. We have now learned about how to use engulfing candles to trade trend reversals at turning points. We have taken a look at inside candles to trade trend continuations. And now let's see another way of how we can trade trend continuations. So at that point, the market is extremely bearish and the market just keeps moving lower and lower. And you can see there's very little pause. We don't have an inside day yet, but can we still trade this? And the answer is absolutely. And this is one of the favorite ways of how I trade trend continuations when I see an extremely bearish trend or an extremely strong trend, regardless of the direction. So what we have here is a market that is just pushing lower without ever looking back. And what we do here is we're going to mark the low of this candle. And clearly, you don't want to fight the downtrend. The trend is clearly bearish and we want to participate. A lot of traders have problems with trading with the trend and they believe that if they see such a trend that the market has to turn around, but that's absolutely not the case. And in most of the times you are much better off when you're looking for trend continuations. Trend reversals are usually very clear, but in this case, it's very clear that the market is going down. So let's go to a lower time frame. And we are here now on the 30-minute where we were going to look for entries. We can see already here some type of patterns where the market is pushing lower. We have significantly lower highs here, as we can see, but the market is still trading above the low here that we have marked off on the daily chart. What we want to do is very, very simple. We wait for a break and retest around this pattern. And this may sound very simple, and for some traders this might even sound too simple. But let me tell you one thing that I've learned in 16 years of trading and now working with traders for almost 10 years is that keeping it simple with your trading strategy is going to help you so much in your overall trading. Try to keep it as simple as possible, and this will help you in your trading and remove so much doubt and fear and uncertainty and the paralysis by analysis that often comes with trading strategies that are too complex. So let's just follow the price action. And we can already see that there's a strong push coming into the market. This is right around the open of the Australian and the Japanese session. That's a good sign that this is happening when the market is opening and when there is a new session coming up. We can just look back. So this is now around 3 a.m. And what we've seen here in the past, around 3 a.m., this was the previous day. That's when the market woke up here yesterday as well. And just look at what happened here. We had here the pushback and a strong selling coming into the market around 3 a.m. We broke here below the low, retested it, and then for the rest of the day continued lower. And this looks really familiar and looks like the market could repeat the exact same thing that it did yesterday. And let me tell you, I've been trading this for a long time now. And this pattern around a daily open, the break and the retest is so common that once you start paying attention to this, you will start seeing this pretty much everywhere. Of course, not every day, but very, very often, if you can find a good trending market, that pattern around the open, be it Tokyo, Sydney, London, or New York, you will find this pattern quite a bit. So now we have the retest here. At that point, the market is pushing higher, and we need to wait to see if this level is holding. All right, the level is clearly holding. It's giving us a great entry price here for the higher time frame trend direction. In this case, we don't even need to have a large stop loss because the market is not very volatile, and when the trend has been going, the market doesn't look back too much. So we could get away with putting our stop loss like that, and then we could start off with our first target at maybe 3 reward to risk ratio. And then let's just follow and see what the price is doing. And you can see as the trading session unfolds in the morning, the trend is continued as anticipated. We see some big pushes, a little bit of a bullish opposition, nothing to worry about. The first targets would have been hit very, very easily, and the market is even continuing lower. So very, very simple, very effective. And I know a lot of traders will say in the YouTube comments this has been cherry-picked. But what I can tell you is that once you start paying to this attention and you become very good at filtering out higher timeframes and only stick with the higher timeframes that have a good trending market, you will start noticing this pattern around the open as a trend continuation everywhere.